A journal entry is a formal record of a business transaction in accounting. It is the first step in the accounting process and serves to capture the financial effects of the transaction on the accounts of a company. A journal entry consists of the following elements. Date, the date of the transaction or when the journal entry is being recorded. It helps in organizing and chronologically tracking the entries. Account title, each transaction affects specific accounts in the company's chart of accounts. The account title identifies the accounts involved in the transaction. Examples of account titles include cash, accounts receivable, accounts payable, sales, purchases, rent expense, etc. Debit and credit, journal entries follow the double entry bookkeeping system, which means that for every transaction, there must be an equal amount recorded as debits and credits. The debit and credit entries represent the changes made to the affected accounts. Debit, the left side of the journal entry is designated for debit entries. It represents an increase in assets, expenses, and withdrawals, or a decrease in liabilities, equity, and revenues. Credit, the right side of the journal entry is designated for credit entries. It represents an increase in liabilities, equity, and revenues, or a decrease in assets, expenses, and withdrawals. It's important to note that not all journal entries will involve both debit and credit entries. Some entries may only require one debit or credit entry, depending on the transaction. Narration, a brief description or explanation of the transaction is included to provide context and details about the entry. The narration helps in understanding the purpose of the transaction and serves as a reference for future analysis and audit purposes. To illustrate, let's consider a simple example. Date, January 1, 2023. Account title, cash. Debit, 500 rupees. Credit, accounts receivable. Credit, sales revenue. Narration, sold goods to customer XYZ on credit. In this example, the journal entry records the sale of goods to a customer on credit. The cash account is debited by 500 rupees, representing the increase in cash due to the eventual collection of the accounts receivable. The accounts receivable account and the sales revenue account are credited by 500 rupees each, reflecting the increase in the amounts owed by the customer and the revenue generated from the sale. Remember, the specific accounts and amounts in a journal entry will vary based on the nature of the transaction and the company's individual circumstances.